Robert Kiyosaki just issued a warning, and this time, it is not about stocks. It is not about real estate. It is about the one asset he says separates the prepared from the unprepared. Because while most investors were watching the headlines this week, something else was happening behind closed doors at the U.S. Treasury. A quiet policy shift, one most Americans do not even know occurred. And it sent gold and silver into a sudden, violent move. Kiyosaki has seen this pattern before, 2008, 1971. The warning signs repeat, and he is not the only one speaking now. Bank of America, Morgan Stanley, economists who rarely agree, they are all saying the same thing. The question is no longer if this crisis unfolds. It is how much time is left before it does. Stay until the end. Because what happens next could change how you think about your money forever. Welcome to Currency Arc Insight, the channel dedicated to decoding the economic warnings that mainstream media overlooks. If this analysis resonates with you, subscribe now and join a growing community of serious investors preparing for what lies ahead. Drop a comment below and let us know which country you're watching from today. On a quiet Tuesday morning, something happened inside the United States Treasury Department that most Americans never noticed. There was no press conference, no dramatic headline flashing across television screens, just a short statement buried in financial reports announcing that the Treasury would double its buybacks of long-term government bonds. To the average person, this sounded like nothing more than bureaucratic language. But to analysts who track the movement of money at the highest levels, it was a signal. And within hours, that signal sent gold and silver soaring by nearly 4% in a single trading session. To understand why this mattered, one has to understand what the Treasury was actually doing. The government had been struggling to sell its long-term bonds, the 30-year and 20-year notes that finance America's spending. Investors around the world were growing hesitant. Nobody wanted to lend the government money for decades at a time when interest rates kept climbing and the national debt kept expanding. So the Treasury made a move. It began buying back the long-term debt and replacing it with short-term borrowing instead. Financial experts call this yield curve control. It is a strategy Japan has used for years to manage its own debt crisis. On the surface, it looks like a technical adjustment. In reality, analysts warn it is closer to rearranging furniture on a sinking ship. Peter Bookvar, a respected chief investment officer, offered a blunt explanation. He said this was not debt repayment, it was simply a rearrangement of the maturity schedule. The government still owed the same amount of money. It was just changing when that money came due. Picture a couple who has racked up $200,000 in credit card debt across several accounts, each charging a punishing interest rate. To ease the pressure, they consolidate everything into a single loan with a lower rate. The relief feels real, but the total debt has not disappeared. It has only been repackaged. This is essentially what the United States government just did on a scale of tens of trillions of dollars. For the business community watching closely, the implications were immediate. When trust in long-term government debt weakens, capital begins searching for somewhere safer to sit. Historically, that search leads to one place, precious metals. Gold and silver do not rely on a government's promise to pay. They carry value on their own, independent of any nation's balance sheet. This is precisely what unfolded within minutes of the Treasury's announcement. Gold jumped by roughly $150 an ounce. Silver pushed back above $66 an ounce, climbing rapidly from levels that had seemed stable just a day earlier. Traders who had been watching for a catalyst suddenly had one. But the bigger story is not the single-day price move. It is what this decision reveals about the broader condition of the American economy. The national debt now stands above $40 trillion, a number so large it becomes difficult to visualize. Every dollar of that debt carries an interest cost, and those costs are rising faster than the government's ability to manage them. Analysts who study these patterns closely point out that this kind of maneuver rarely happens in isolation. It tends to appear at moments when other options are running out. When a government begins adjusting the structure of its debt rather than reducing its size, it often signals that pressure is building somewhere beneath the surface, pressure that will eventually need to be released. For young entrepreneurs and business owners building wealth in this environment, the lesson is not about panic, it is about awareness. Financial systems send signals long before they send headlines. The Treasury's decision may look small on paper, but for those trained to read the deeper story, it read like an early warning. The gold and silver markets have already responded. Wall Street's biggest institutions are watching. And in the following segment, the analysis moves to why banks like Bank of America and Morgan Stanley are now making a case that has not been heard in years. For years, the biggest banks on Wall Street rarely spoke about gold with any real conviction. It was treated as a fringe asset, something for cautious retirees or doomsday preppers, not for serious institutional portfolios. That silence has now broken, and the shift in tone has caught the attention of analysts across the financial world. Bank of America was among the first to change its position. Michael Hartnett, one of the bank's most closely watched strategists, wrote plainly that the trade is now long gold. He described it as the strongest available hedge against a weakening dollar. This was not a passing comment buried in a research note. It was a direct statement from one of the most influential voices in global finance, and it carried weight. The numbers backed up his words. Gold funds pulled in $6.3 billion in a single week, the largest amount since January of 2026, a month that also happened to mark a major surge in the gold price. When capital moves at that scale, it rarely moves without reason. Large institutions do not shift billions of dollars based on speculation. They move based on data, risk models, and a growing unease about what lies ahead. Morgan Stanley added its own voice to the conversation. Chief Investment Officer Mike Wilson stated that gold has actually been in a bull market for 25 years, a claim that surprised many casual observers who assumed gold was a stagnant, old-fashioned asset. Wilson explained that the traditional strategy of holding 60% in stocks and 40% in bonds, a model that guided investors for decades, is no longer delivering the protection it once promised. His reasoning was direct. Gold and other hard assets, he explained, are built for environments where traditional portfolios begin to fail. He noted that gold does not pay a dividend and does not generate yield the way stocks do. Yet over the past 10, 20, and 30 years, it has still outperformed large portions of the stock market. For a business owner or entrepreneur thinking about long-term wealth protection, that kind of performance without reliance on a company's earnings or a government's promises is difficult to ignore. What makes this moment different is the timing. These statements from Bank of America and Morgan Stanley did not appear in isolation. They followed closely behind the Treasury's yield curve control announcement discussed earlier, and behind a broader pattern in central bank behavior. Around the world, central banks have been quietly increasing their gold reserves for several consecutive years. Recent data shows that official gold holdings have now overtaken foreign Treasury holdings as the leading reserve asset among many nations. This shift matters because central banks are not emotional investors. They do not buy gold because of headlines or social media trends. They buy it because it represents a form of security that does not depend on any single government's ability to pay its debts. When multiple central banks and now major Wall Street institutions begin moving in the same direction, it signals more than a passing trend. It signals a recalibration of how the world's largest financial players view risk. For entrepreneurs and business-minded individuals, this pattern offers an important lesson. Retail investors, the everyday public, are often the last group to notice these shifts. Institutional money tends to move first, quietly and steadily, long before the broader public catches on. By the time a trend becomes common knowledge, much of the early opportunity has already passed. This is why analysts describe institutional gold buying as a leading indicator rather than a lagging one. It reflects where sophisticated capital believes the economy is heading, not where it currently stands. Bank of America and Morgan Stanley are not known for dramatic predictions. Their language tends to be measured and calculated. That is precisely why their recent statements carry so much significance. As this institutional shift continues to unfold, another voice has entered the conversation, one far more recognizable to the general public. In the next segment, the analysis turns to Robert Kiyosaki and to the specific warning that has placed silver at the center of his latest message to investors. Robert Kiyosaki has spent decades building a reputation as one of the most outspoken voices in personal finance. His book, Rich Dad, Poor Dad, shaped the thinking of an entire generation of entrepreneurs. Whether people agree with his views or not, his track record on economic warnings has earned him a wide and attentive audience. So when he speaks about the direction of gold and silver, business owners and investors take notice. His latest comments center on a bold prediction. Kiyosaki referenced projections from Jim Rickards, a respected economist and former government advisor, who has stated that silver could reach $200 an ounce, with gold potentially climbing toward $10,000 an ounce. These are not small, incremental forecasts. They represent a fundamental shift in how these metals could be valued in the years ahead. What stood out in Kiyosaki's message was his specific focus on silver. He explained that between the two metals, he currently views silver as the stronger opportunity. His reasoning connects to something analysts call the gold-to-silver ratio, a measurement that compares how many ounces of silver it takes to equal the value of 1 ounce of gold. When this ratio becomes stretched too far in one direction, it often signals that silver is undervalued relative to gold, setting the stage for a sharper upward move. Kiyosaki closed his message with a line that captured attention across financial circles. He said that savers of cash are the biggest losers. This statement reflects a core principle he has repeated for years. When a government manages its debt through strategies like the yield curve control policy discussed earlier, the value of money sitting in a bank account slowly erodes. Prices for everyday goods rise, while the purchasing power of saved dollars quietly shrinks. To understand why this message resonates so strongly right now, it helps to look back at history. In 1971, President Nixon removed the United States from the gold standard, severing the direct link between the dollar and a fixed amount of gold. At the time, this was framed as a temporary measure. It became permanent. Analysts often describe this moment as the first in a series of expanding monetary interventions, each one larger than the last. Since that decision, the dollar has lost a significant portion of its purchasing power. Meanwhile, the money supply has expanded dramatically, particularly during major crises. Analysts frequently point to the years following 2008 and again around 2020, when trillions of dollars were introduced into the financial system in a short period of time. Each expansion followed the same basic pattern. A crisis emerges, the government responds by creating more money, and the value of existing currency weakens as a result. This is the backdrop against which Kiyosaki's silver comments should be understood. His warning is not simply about a single asset climbing in price. It is about a much larger pattern of currency weakening over time, one that has repeated itself for more than 50 years. For business owners and entrepreneurs building long-term wealth, this pattern raises a difficult question. If cash consistently loses value during periods of economic stress, what role should it play in a well-protected financial strategy? Analysts who study these cycles suggest that assets like gold and silver serve a different purpose than growth investments. They are not designed to generate rapid returns during stable periods. Instead, they are designed to hold their value when trust in a currency weakens. Precisely the environment many economists now believe is developing. Kiyosaki's comments, paired with the institutional shifts already underway at Bank of America and Morgan Stanley, paint a picture of growing consensus among very different types of financial voices. A best-selling author, two of the largest banks in the world, and a respected economist are now pointing in a similar direction. The next part of this analysis moves beyond individual predictions and into the mathematics behind the crisis itself, examining exactly how large America's debt burden has grown and why analysts describe it as a spiral that becomes harder to escape with each passing year. Behind every headline about gold, silver, and market predictions lies a much larger and more troubling story, one built entirely on numbers. To understand where the economy may be heading, it helps to look closely at the mathematics of America's debt, because the figures reveal a pattern that few people fully grasp. According to recent data from the Kobusai Letter, a widely followed financial research group, the United States paid $1.4 trillion in interest on its national debt over the past 12 months alone. That number by itself is difficult to comprehend. It represents money spent purely to service existing debt, not to fund schools, infrastructure, defense, or any other government program. It is simply the cost of borrowing. What makes this figure even more concerning is the direction it is heading. If interest rates remain at current levels, analysts project that annual interest payments will climb to $1.7 trillion by the year 2028. At that point, interest on the debt would surpass Social Security as the single largest expense in the federal budget, a milestone that has never occurred in the nation's history. This creates what economists call a debt spiral, and understanding how it works is essential. As the national debt grows, the interest owed on that debt grows alongside it. As interest payments increase, the government's overall deficit widens, because more money must be borrowed simply to cover the interest, not new spending. As the deficit widens, the total debt grows even further. Each part of this cycle feeds the next, and once it begins accelerating, it becomes increasingly difficult to slow down. This is not a uniquely American problem. Japan, one of the largest economies in the world, is experiencing similar pressure. Its 30-year government bond yields recently climbed to their highest level on record, a signal that investors are growing hesitant to hold Japanese debt for long periods, much like the hesitation seen in the United States bond market discussed earlier in this analysis. Japan also happens to be the largest foreign holder of American debt, which means pressure in one country's bond market can quickly influence the other. For entrepreneurs and business leaders trying to make sense of this environment, the key question becomes simple. When a government's interest costs rise faster than its ability to pay them, what options remain? Historically, there have only been a few realistic paths forward. One option involves significant spending cuts, a politically difficult and slow process. Another involves raising taxes substantially, which carries its own economic consequences. The third option, and the one history shows governments turn to most often, involves creating more money to cover the shortfall, a process that gradually reduces the purchasing power of every dollar already in circulation. This is precisely why analysts continue pointing back to gold and silver throughout this discussion. These assets are not tied to any single government's promises or spending decisions. Their value does not depend on whether interest payments are manageable or whether a debt spiral can be contained. This independence is exactly why central banks, major financial institutions, and prominent voices like Robert Kiyosaki have been shifting attention toward precious metals with increasing urgency. None of this suggests that a collapse is guaranteed or imminent. Economic systems are complex, and governments have more tools available than most people realize. But the pattern emerging across multiple independent sources, the Treasury's yield curve control decision, Wall Street's renewed interest in gold, Kiyosaki's public warning, and now the accelerating mathematics of the national debt, paints a picture that is difficult to dismiss as coincidence. For business owners and young entrepreneurs building wealth over the long term, the lesson is not about fear. It is about preparation. Understanding these signals early, before they become mainstream headlines, is what separates reactive decision-making from strategic planning. The warning signs are visible for those willing to look closely. What happens next depends on choices being made in boardrooms and government offices right now, choices that will shape the value of every dollar and every ounce of gold and silver for years to come.